question that there is a lot of information. The place we find ourselves is at the intersection of politics and investing, and it's not somewhere that we haven't been before, Danny, but there's certainly something that we need to talk about is, do we have a deal, or don't we have a deal, or do we have a deal? And that was really what we saw this week.
Right. The president on Thursday announced that he had a deal on infrastructure, an additional $597 billion in stimulus spending, which puts the total package there at around $1.2 trillion with a T. But it's contingent on the passage of another bill, which is far more significant and larger in terms of healthcare infrastructure and the rest, that the Republicans seem to be dead set against. And so it's essentially a legislative two-step. If I get this and I get that, then we get them both. And if I don't get that, we won't get this. So it's very confusing. And, you know, it affected the markets for sure. I mean, the infrastructure stocks went up pretty sharply on Thursday. They gave back most of their gains on Friday because the second bill isn't just about spending. It's also about taxes. And taxes hit first. The infrastructure takes a long time to spend, but tax bills hit immediately.
Yeah, that's exactly right. So Nancy Pelosi said, you know, either they go together or they don't go at all, to which Lindsey Graham called it a deal breaker. So certainly worth watching. And, of course, Congress goes on break in August, so there is a timing to this as well. So we'll have to watch the Sunday morning talk shows tomorrow to see if there's any movement at all. But it's certainly something we need to watch because it has an effect on a number of issues. And as you said, we saw Caterpillar, Deere, AECom, and a number of other infrastructure stocks rally and then give it back, as you pointed out. But the other thing I do want to point out is for sure we saw a lot of news out of the Fed once again.
On Thursday, the Fed announced that the major banks had passed their recent stress test with flying colors, which essentially gives them the ability now to do stock buybacks and dividend increases, which we've talked about often on the show that we thought was likely. One of the reasons why it's a tactical position in our portfolios. But it basically puts the financials in a much more inviting spot for investors because, you know, those dividends had remained flat or non-existent, and that's certainly attractive in a low-rate environment. And the valuations in the financial sector, generally speaking, are relatively good versus other sectors.
And why do we watch that? It's certainly because of what's happening with interest rates. We see the 10-year Treasury just stuck in about 1.5% for a long time now, and maybe the bond market is just not believing that this success that we're having with GDP reports, and again, we saw the Atlanta Fed come out again with a double-digit report for next quarter, that they don't believe that it's going to be sticky and it's going to roll off into next year.
Right. I mean, the inflation is something that, you know, it's all about expectations, and the real anchor for inflation is in wage growth, and we are seeing companies have to offer higher wages to get people back to work. I mean, the government has essentially been competing with them at some level by virtue of enhanced unemployment benefits, but at this point 26 states have rolled back that extra unemployment benefit.
Yeah, that's right. And we saw the chief whisperer in charge yesterday whispering in and saying pay people more. I can't really do it, Danny, but he whispered pay people more. But, you know, well, I think that's exactly right. The government has become a competitor to small businesses who are trying to get people back to work. So we're going to pay attention to that as well. And lastly, I just really want to talk about, you know, what is in your portfolio, because there's so many sectors that are being affected by this, not only domestic sectors when you think about financial technology and healthcare, fixed income sectors, and that's really when you think about a 60-40 split in a portfolio. The 40 generally represents the fixed income. That needs attention. There's no question that changing interest rates will have a lot of effect on your fixed income portfolio. You need to know what's in your portfolio, how much you're paying for it, and why you own it.